risk-focused, compliance-heavy, legacy-driven.
And in between, a massive opportunity.
No one's fully captured innovative, forward-thinking, obsessed with decentralization. On the other side, traditional.
There's a global system that underpins nearly everything, from your home and car to your business, your health, even your cyber data. It's the insurance industry.
Let's start with something simple. Bitcoin and insurance both deal with risk, but in completely different ways. In Bitcoin circles, people talk about inflation hedging, sovereign risk, and financial censorship. But in the insurance world, it's all about actuarial tables, liability coverage, counterparty risk, and regulatory solvency. What's wild is both sides are solving for uncertainty, just using different vocabularies. Bitcoiners don't always grasp the scale and mechanics of risk transfer that insurance enables. And insurers rarely understand Bitcoin as a long-duration, low-counterparty hedge against systemic failure. Here's where it gets fascinating. Bitcoin has the potential to be a game changer for long-duration insurance liabilities. Insurance companies typically match liabilities with conservative investments. Government bonds, high-grade credit, maybe some equities. But in an era of negative real yields and inflationary policies, those strategies don't work like they used to.
What if Bitcoin could act as a reserve asset for long-dated liabilities? What if insurers saw it as digital collateral, not speculative, but sovereign, scarce, and independent of fiat dilution? The use case for Bitcoin in that world isn't about getting rich quick. It's about surviving long, about protecting capital over decades, not months. Now, Wall Street and traditional insurance firms aren't stupid. They're just siloed. They've been trained for decades to think in models that assume stable governments, functional monetary policy, and predictable inflation. Bitcoin breaks those assumptions. But here's the kicker. Bitcoin is slowly bleeding into that world. You've got public companies adding it to treasuries, asset managers launching ETFs, and reinsurers starting to experiment with digital assets. Still, they don't know how to model it. They don't know how to regulate it. And more importantly, they don't understand how to insure it. This is where the opportunity is, and honestly, it's why I'm here. There's a desperate need for bridge builders, people who can speak both Bitcoin and insurance, who can explain volatility not as a bug, but as a feature, who can reframe Bitcoin as a tech stock, but as a monetary foundation, and insurance policy on monetary policy itself. Likewise, Bitcoiners need to understand how insurance protects everything from life to property to supply chains, and how incorporating Bitcoin into those mechanisms makes them more resilient. This isn't just theory, this is infrastructure. The next financial layer isn't just decentralized finance, it's decentralized risk management. It's Bitcoin as collateral, as capital reserve, as a peace of mind asset. Both sides, Bitcoin and Wall Street, think they're playing different games, but they're actually building the same thing, a system that can survive chaos. If you get this right, Bitcoin won't just be an investment. It'll be part of the global safety net, a foundation beneath trillions in risk exposure. That's why this moment matters. And that's why being a connector and educator is no longer optional.
So that's a lot of where I am really trying to spend my time, is being that educator on both sides, bridge builder and dot connector, because that is what is desperately needed kind of between those two worlds.
Inflation, negative real yields, and fragile fiat systems are eating away at long-term solvency. But there's one asset that's misunderstood by insurers and misused by investors that may be the key to fixing it: Bitcoin.
When you zoom out, insurance isn't just a local business. It's a global ecosystem. Companies like Allianz, AIG, Swiss Re, and Munich Re write global risk, from hurricane losses in the Gulf of Mexico, to earthquake risk in Japan, to cybersecurity policies in London. It's all interconnected. The total global insurance industry, north of $7 trillion in premiums annually, managing well over $35 trillion in assets. And yet, the entire model relies on one fragile assumption: that fiat currencies will retain value over time. But that assumption is breaking. Here's the problem. Insurance carriers hold massive, long-duration liabilities. A life insurance policy might not pay out for 30 years. Catastrophe reserves are set aside for once-in-a-century events.
This is assumption they're so racist averse that they're trying to bring up to retelling that first, you were coming to, time and terrible to some of these species is the detection or subjective, coming off from caps and finding our stands.
To hedge that, carriers traditionally use conservative investments, government bonds, cash equivalents, investment-grade corporates, safe, predictable. But what happens when real yields go negative? When inflation hits 5%, but you're earning 2% on treasuries? You're guaranteeing a loss, not just for a year or two, but for decades. This is the quiet crisis. Carriers are under siege by the very macro forces Bitcoin was built to hedge against. Bitcoin isn't just a new asset. It's a new monetary foundation, fixed supply, decentralized issuance, no political tampering. It's not someone else's liability. For insurers, especially reinsurers who manage tail risks, Bitcoin could act as a reserve asset. Think about that. Not a speculative bet, but a core solvency hedge. Imagine holding 1 to 5% of reserves in Bitcoin, not for volatility, but for policy continuity in the event of fiat debasement or bond market collapse. Bitcoin becomes the backstop to the backstop. So why hasn't this happened yet? Insurers are conservative by design. Their regulators demand capital buffers in traditional formats. Their models rely on Basel rules, Solvency II frameworks, and actuarial consistency. Bitcoin? To most, it's too volatile, too unproven, too unregulated. But here's the kicker. The volatility premium is shrinking. The regulatory clarity is improving. And the existential need, that's growing by the day. Most people don't realize that global insurance carriers write risk across currencies and across borders. You might have a policy written in Turkish lira, reinsured in Swiss francs, and priced using US inflation metrics. That complexity needs a neutral settlement asset. And Bitcoin might be the first viable candidate in history. It's borderless, it's liquid, and it's apolitical. In inflation-ridden economies like Argentina, Nigeria, or Lebanon, insurers are watching claims spike while their reserves erode. Bitcoin offers them a way out, a universal value layer that can plug into a fractured monetary world.
This
is where the bridge needs to be built.
Over time,
Actuaries,
for
underwriters,
Bitcoin to kind of
CFOs, they need to see
solve some of
Bitcoin not as a
these,
bet, but as a hedge,
pernicious
a
inflation
portfolio
issues, 'cause carriers are getting
diversifier,
hit
a
with the same
liquidity layer,
inflation
a
issues
long-term
of-
inflation sink. That takes education, risk modeling, real-world case studies. We need pilot programs, maybe reinsurers testing 1% Bitcoin allocations for long-dated tail events. Maybe parametric policies with BEC-settled claims. Maybe Bitcoin-denominated reinsurance pools for catastrophe bonds. This is the hard, boring work, but it's what unlocks real change. Some institutions are already inching closer. Fidelity has integrated Bitcoin into retirement options. BlackRock and Franklin Templeton are bringing ETFs to market. MicroStrategy holds over $15 billion in Bitcoin as a reserve strategy. Insurance, still early, but it will come because the pressures that Bitcoin solves are only intensifying. Inflation, fiscal instability, geopolitical fragmentation, fiat skepticism.